Hello, everybody. We welcome you to our Startup Leaders Club, online panel discussion by inspirational leaders of innovation and drivers of change. And today we are discussing business model pivots in the era of pandemic with serial entrepreneurs from different backgrounds, industries, and from different parts of the world. And my name is Nadya Nesterova. I'm an independent director of the board of the National Alternative Investment Management Association and advisor to leading GPs in private equity, real estate, venture capital, and hedge funds. And let me start with a brief round of introductions of our today's speakers. Doland, please introduce yourself. You're one of the recurrent speakers of our Startup Leaders Club. So just welcome again.
Yeah, thanks, Nadya. It's good to be here. It's good to see everybody. It was a good conversation before we started. So I'm Dolan White. I'm a CEO founder of a consultancy. I have two other business ventures that I'm partnered in. But my primary focus is from a consulting perspective is I spend my time working with organizations on accelerating their outcomes with mindset and culture and helping companies and executives kind of keep their heads screwed on properly through this whole sort of event. I come with 30 plus years leading large organizations in the software industry and mergers and acquisitions and capital acquisitions and expenditures. So that's my background coming in. It's great to be here with everybody. This will be a good conversation today. So thanks, Nadya.
Yeah, thank you, Dolan. And Leon also speaks with us and our recurrent speaker at the club. So welcome again, Leon.
Thank you, Nadya. I'm Leon Eisen. I'm founder and CEO at Occitan Medical, and I'm inventor of the world's first FDA-cleared pulse oximetry monitor at wrist. Today it's a very important and I would say crucial product to monitor patients with COVID-19. So our business is growing, and we're working in almost all countries worldwide already. And I spent 20 years in health tech in different positions, starting from engineering position, scientist in the beginning, then engineering position, and executive. Now I'm entrepreneur and CEO, and maybe next stage will be investor.
Thank you, Leon. And Seth is also with us several times during our panel discussions, and you're also serial entrepreneur and investor. Could you also join us today?
Absolutely. I hope everyone can hear me. Thank you very much, Nadya, and the whole team here for having me again. It's a pleasure to be back. We talked about something important. My name is Seth Page. I'm a co-founder and chief executive officer over at Throughput.ai. We specifically use existing data sets with our AI software and typically siloed legacy type of data to solve operational supply chain problems for companies that are out there. This is my 8th startup as a co-founder and executive. 6 have been acquired to date. The 7th one's out there still going very strong, and this is number 8. Before that, I was a programmer for 10 years. I was an investment banker and in private equity and venture capital, and an angel investor for about 15 years as well. So look at it from both the startup entrepreneur side, the operational, how do you run a company, get things up and running and scaled, keep it going side, and also the financing side, where the spam, where the sausage is made, and how things really work. So glad to be here and look forward to a lively conversation. And most importantly, I want to know where Christian's coming in from, because that looks beautiful.
Yeah, hello, Christian. Welcome to the club. Please introduce yourself.
Yes, I'm in a sunny place in Spain at the moment. My name is Christian, and I am a serial entrepreneur in tech. I had my first company in the US when I was 24, doing a jewelry e-commerce business already very early 2000. And then I started another company back in 2008, which was sold in 2012, doing a video compression technology. And the business I've been working on for the last 8 years is an AI application for small merchants, which handles everything in your business. So it's a cooperation between MasterCard and Amazon and the company Shopbox that I founded. And the idea is to make the physical shop like a virtual shop, like a web shop. So it's basically like how to provide Amazon Go to every shop in the world. That's very interesting. And we make money on payments and also on licenses. And I'm the chairman of the board of this company now. and have a very strong, value proposition, and hopefully a very bright future. So that's my background.
Thank you,
Happy to be here.
Christian.
Thank you.
Yeah, thank you. We're also happy to have you today. And Uri, could you also introduce yourself and your businesses?
Sure. My name's Uri Pomeranz. Great to be here with everyone. I'm a serial fintech entrepreneur. I started a microfinance fund with Israelis and Palestinians years ago. I started a financial advisory tech company that was acquired by a big insurance company, and then a robo-advisor for millennial couples, very niche. Most recently, I'm a venture investor at Jackson Square Ventures. We're a Series A venture fund in San Francisco. We tend to focus on anti-hype type of businesses, typically invest $4 to $6 million upfront with a spike in enterprise, fintech, marketplaces, but we'll invest all over the place. So looking forward to the discussion and really looking forward to getting to know folks on the call and all the questions as well.
Thank you, Uri. And James, welcome to the club, and introduce yourself as well.
Thank you very much for having me. James Barry from Beacon Talent. I have a background in primarily fundraising and building businesses, currently focused on building out Beacon, which is a small talent consultancy working usually with startups that are small to medium and are growing. Thank you very much.
Thank you, James. And so we'll start with several rounds of questions. And Uri, would you like to start? So what is in the focus of your attention as investors? So what businesses are you looking for, and what should be in top of their priorities to get into your portfolio, especially during this situation when we're between the first wave, second wave, or just the curve for the first wave?
Yeah, I think, there's so much going on in the world right now that it's the fundamentals still really matter. So I think the most important thing for any business is just focusing on, do you have a product that your customers really, really love, right? So things that are truly changing the lives of your customers and they have to use every day, and then building a great business behind it. So for Jackson Square Ventures, we typically look for, at least on the SaaS side, do you have $500K to $1 million of ARR? Are you sort of growing in a sustainable way? So while you're sort of looking at that customer love and building out the product, keeping in mind your LTV for your customers and your CACs, and even if you just have a team of biz dev people, really trying to measure their time and keeping track of, is this growing in a sustainable way? So I think that's a real challenge, especially at an early stage around, are you focusing on a very simple value prop that customers love, talking to customers, doing things that don't scale, at the same time, having a good plan around how does this business get to $100 million a year of revenue? And at that point, how does it grow 30 to 40%? So I think kind of keeping both the big picture and that sort of the micro customer love in mind as well. So also in this environment, I think, especially for businesses that are sort of just fully digital and building platforms and helping people do business and sell and engage with customers fully digitally, it's a wonderful time because in many ways, sort of a secular trend is just accelerating now. So I think that's great in terms of really accelerating businesses that sort of would have had slower uptake before. And lastly, from a personal perspective, just acknowledging the humanity of everyone. Starting a company is super, super hard. I have so much commendation for people that are starting companies. It's hard when things are going perfect, and it's sort of doubly or triply hard during this time. So just, I think as an entrepreneur, taking time to, sort of take care of yourself, take care of your family and your teams, and really just approach this as a marathon. Hopefully we have a vaccine and we're sort of on to the new normal within the next year or two, but this could be multiple years. So really trying to kind of view the next couple of years as a marathon and raise more money than you think you're going to need to, and just sort of plan to weather the storm ahead. So yeah, just a lot of commendation for entrepreneurs, but customer love, keep that long-term business model in mind in terms of scale, and then take care of yourself and your team and mental health as well.
Thank you, Uri. And James, so what is the top priority in terms of talent management and maybe competencies within teams during this kind of crisis? So do you get any special requests from your clients during this turmoil?
Definitely. And before I expand upon that, just kind of piggybacking off of what Uri said, mental health is definitely a very big thing that I don't think is discussed from my call we had yesterday. It was a call out that not only are we likely dealing with that as a company, but that our clients are as well. So just knowing that everybody's going through their own kind of different experience right now, whether or not it's a founder you're talking to or just somebody working at your company, I think it's very good to be conscientious of that. In terms of the talent industry, big trends that we're noticing, obviously working remotely is changing how everybody is doing business, so building new processes, new systems, rituals, and values that really reinforce your culture is more important than ever. If you had a good, strong culture going into that, it's great, but there are a lot of companies that were helping pivot around how they interact with their employees, how they communicate their value and translate the mission of what they're doing on a day-to-day basis to the people they work with, keep them engaged. Additionally, I think talent is also more important than ever just because you're not working with these people directly. And while people had remote businesses before, it's really important to make sure the people you're working with are engaged and focused every single day when they're working from home. And lastly, this has at least been a big trending topic in the US, diversity and inclusion. It's really kind of started to move to, I think, the forefront of a lot of founders' minds. And while it's been important to have diversity of thought and diversity of background before in companies, given the recent activities in the US, the protests, the social movements, we view that as a key component of how companies are being built. And it's the smaller companies these days that can build their structure right from the ground up to make sure that they have a basis of inclusion and an open culture that everybody's happy to be in.
Thank you, James and Seth. So you're wearing several hats, and you've been entrepreneur, and now you are serial entrepreneur and investor, angel investor. So what keeps you inspired in this multiple kind of endeavors?
Yeah, I mean, this is like some of the folks on here. This isn't my first story. This is my fourth major economic crisis during my adult career. 6 throughout my entire life. So I'm a bit older than my hair color might give you. I think the biggest thing is just human tenacity. When people step up for the moment, they help their neighbors out, they help other startups out. I think if you look at, for those of us who have children, at the ways schools quickly pivoted in ways that you would have never expected a school board, teachers who are older and uncomfortable with online tools to suddenly, 48, 72, 96 hours later be online teaching classes, which for them was a completely unknown. These are people who do their school plans a year in advance, and suddenly they're completely redoing things on the fly and trying to figure out how to manage classes. From a venture capital point of view, I mean, I think it's been pretty clear. It's bifurcated very quickly in 2 directions. Those who have more than 50% dry powder are actively out there doing deals, will actually close deals over Zoom. They may take more time getting there, which always happens during a VC super cycle on the downward cycle, but they're getting it done. And those that, by rule of thumb, have 50% or less dry powder, so they're typically reallocating that for their perceived winners. They're letting their losers know they've got to cut costs. They're on their own. They might participate in another round led by someone else, but you're seeing that natural Schumpeter effect, that culling of the masses that happen with every VC trend out there. And I think it's particularly stark right now, with the biggest difference being markets have come back so quickly disjointed from the economy because of low interest rates that you're starting to see, really stupid, dumb money flow in chase deals that are hot, right? The FOMO, fear of missing out. Like deals like Clubhouse, right? You've got 5,000 beta users, no plan for how you're going to get profitable. And it's, 80% of the groups that are using it are VCs who are at home, no offense to Uri there, but cashing their 2 and 20 and not actually out there doing anything else. but managing their portfolio. So I think that's that. And on the employee side, I think James and Uri made some really good points. Is how do you keep your culture together? And part of your culture is mental health. And in a world where you don't have that social interaction, it's very difficult. So all 7 of my 8 companies have been remote. We've been using remote workers from the days you used to use H321 protocols over dedicated video conference equipment, right? This is going back to the late 90s, early 2000s. It wasn't expensive. It was $36,000 to $80,000 to set up video conferencing between your New York and your California offices. Now everyone has it at their fingertips. So as long as you have bandwidth, which again, some rural communities, some urban communities have issues there. So there is a huge divide between the haves and the have-nots on the digital side in particular. But as long as you have a phone with a few bars, you can participate, you can learn, you can continue to work. And on the client side and partner side, people are much more willing to move projects forward and close deals, not going face to face. Because for those countries where wearing a mask isn't a political statement and traveling is not allowed except for in the more dire circumstances, they're willing to close deals that make sense. They have budgets. They've figured out what this year is going to look like more or less, and where they're going to spend money and where they're going to cut money. So I think you just in general human tenacity and adaptability and making it happen, right? And being able to keep the economy going through hell or high water, because we're all in this together.
Thank you, Seth. And Leon, so you are in one of the most vital segments, so for all of us in healthcare. So what's new on your side? Any news, breakthroughs? I think your business is flourishing anyway, but maybe something.
There is something. And in the beginning, I would like to thank Seth for your observation. It's very important, because what I feel and what I see by myself, efficiency is growing very much working through Zoom or something like this, because before I had to spend a lot of money, a lot of time to fly to different country just for a couple of meetings, then back. And overall efficiency was about maybe 5% maximum. So I lost a lot of money and time in non-efficient way. And currently efficiency of making deals using internet, it's maybe 15-20%. So it's growing and growing all the time, because more people you can reach out. And it's amazing that even via internet, you never meet this guy, but never met, but become friends. So friends, internet friends, something like this. I told before it could be via Facebook for our kids or something like this, but it happened with us. That's amazing. About our changes, yes, last week we start the first clinic in United States, and we decided to try to explore a new business model. We didn't think about it before, because we tried to sell in volume our product, and it's quite difficult, and it requires a very long stages. We succeeded in this, but not how we would like to. So we pivoted a little bit, and we decided to rent our product. And just a little bit about product. It's a platform that enables digital, we call it digital or remote continuous care. So if compare, it's a little bit different, and the difference in cutting-edge technology and different in value proposition. So if you know the main problem of COVID, what COVID revealed now, that elderly patients, people with very severe conditions, they were all the time out of the, I would say, healthcare business, despite the fact they consume 80% of our money and time. And this is what we were talking about for the last 10 years. Nobody was going to hear about it, because it's very difficult to manage these people. All technology is dedicated to some averaged chronic patient, some one-time measurements, random measurements, and give you some sense of what happens, but it's not wonderful picture, so you lose a lot of information. And suddenly we were first, not suddenly, we were first on the market who deliver continuous information from medical device. It's not Fitbit, it's not, it's a medical data. And we do not deliver just data. We deliver actionable answers, actionable insights. This is what our customers are looking for. Not data. People do not data. But if actionable insights ask you for action, you can get very deep insight and take data like in ICU, but from people at home. And this is totally new because this is a world first wearable, and we don't have other way to get data from the patient in continuous manner, only using wearables. We don't have implantables yet. It will happen, but not now. And we decided today to rent this wearable, to rent our platform for a week, for a couple of weeks, to monitor continuously COVID patients at home, to build their baseline. And they don't have to come to the hospital for check. And we can catch up with, for example, silent hypoxia. You know, it's a very important thing. Then oxygen saturation goes down and people do not feel it. That's amazing. People should die at this oxygen saturation, 80%, for example, and they don't feel it. That's amazing. And we feel this, and we deliver this information to relevant physicians and clinicians, and we save their life.
Thank you so much, Leon. And Christian, what's new in your customers' behavior? So, which you could highlight?
Yes, in our case, we sell a simple all-you-need solution for small merchants. So, of course, we had some issues with, what's going to happen with small merchants. Are people going to start shops? And as we take all the transactions for these merchants, we also saw a decrease in the sales overall of 70 to 80%, on all kinds of transactions, and money like cash going completely out of the equation because no one wanted to touch cash, in the early days of the C19. What we realized is that, there's a lot of need for good technology. And as I also said in the pre-conversation, if you have like a sustainable, value proposition, a good offer, if you're in it for the long run, if you didn't just start a business to get out of it, then you have something in this new era, because the customers are demanding more and more. And then in our case, like these small merchants, they would like to have the same tools as a big department store or chain store, but they don't have the necessary resources. They don't have the CTO. They don't have all this information, but they compete in a very hostile environment. Getting people to go to the shop and do things is a very it's a very delicate situation for most retailers, and therefore they're fighting for their lives, I guess, in many cases. And they realize that they need to step up, the game. They need to get to know their customers. They need to, get more on track, so to say. But I think that's the good thing about the C19, that it woke people up.
And to add on to that, Christian, you made me realize that I've had this cash in my wallet since February, and I think it's okay to touch it in July now because it's definitely COVID free. But it has been a cashless world, at least for me, for 4 months.
So you have a souvenir now.
It's the new system in a way.
Yeah.
That's
very much so.
Yeah.
And Dolan, what are the most recurrent questions and issues your clients get into for your recommendation? So what would you like to highlight?
It's interesting. So and to Seth's point, I have no cash in my wallet. It's funny because I don't think I've been to an ATM since February either. So I've not had any reason to carry anything in my wallet at all, but my gold card and a piece of paper, and that's it. That's all that lives in my wallet these days.
Mad Max should be disappointed there, Dolan.
Anyway, but no, it's interesting because I think that, and I love the comments by everybody on it because there's, just from an initial perspective, we've covered a lot of different kind of topics. Data-driven information, which is critically important, and Leon, to your point around wearables, and to be able to know and build those baselines so that you can track and see what's happening with those people on a daily basis. You know, as an example, so I have 5 sons. Youngest son, at the onset of the coronavirus, was assumed by the doctor that he had coronavirus. So he did a test, and he had to wait 14 days to get his test result. And it literally was 14 days of a vacuum. So you don't know for 14 days how you are. And by the time you get to the 14th day, he was completely, totally freaked out. And then the call came in at the end of the 14th day to say, you know, knock on wood, you're healthy, and, you know, go back to work. And then you've got to uncoil that whole episode about being freaked out. So it's kind of a miniature PTSD kind of an event. So it's an interesting thing. It's been fascinating. You know, one of the things that I talk with my clients about is there's this Warren Buffett saying about never let a good crisis go to waste. And in this moment of crisis, it's an opportunity to, if we think about where we are, who we serve, and what our true visions are, it gives us a chance to step back and reinvent our process, rethink about who we are as individuals, as companies, and refocus and do things different. And I share a lot around the concept around airports, and we have the kind of I watched an old episode of Seinfeld a couple of weeks ago, and George went to the gate to pick Jerry up. And Jerry came off the plane and he was met at the gate, and they went and got in a limousine. Of course, it's the hero's journey. They got in trouble for the next 23 minutes. But the concept was they were there. And then, of course, we had a 9/11 event, right, that changed everything. And then post 9/11, now we have different processes. But yet the consistent thing is we have planes in the air. We have supply chain with petroleum being delivered to the planes. We have food being delivered to the airports. So the guiding the fundamentals remain consistent. The manner in which we do business changed. And I think we're kind of in that space now with COVID, with this concept of the fundamentals of business, and I think Uri, you mentioned that about the kind of the first thing you said was good, you know, good business fundamentals. And
I think also, like, you know, it's really like everyone has to man up a little bit. It's been really easy for everybody the last 20 years, right? So everyone is like doing well. They all have good jobs. You know, it's everything from like going into a company to being successful with a business that is not necessarily like a really good and very needed product. So this is what I mean with this big, you know, cleanup in a way. You know, now every business owner from small to big has to really think, you know, are we doing the right thing? Are we profitable? Are we, you know, buying the right like things and stuff? And in our case, for example, all these, like, why we're also doing so great in this Corona thing is that, you know, all the different merchants are you know, using legacy systems, old IBM systems, Microsoft-based, you know, e-server solutions, very expensive to maintain, a lot of service around it, and only like 15% are using the cloud-based services such as Square and these other players. This, you know, so just in our little space, you know, everyone has to think about, we don't want to spend all this money. We don't just want to have all these suppliers of all kinds of different things. We can't afford it, you know, and that's kind of like a shakeup, you know, in how we think. And I think also it goes all the way, our other clients are the banks, right? So they always been so lazy. They don't want to do stuff. You know, they had enough. After the C-19, everybody wants to work with startups and fintechs because they have to do something, you know, because they need to make money on these customers, and they actually need to take them seriously and maybe create a loyalty. And, you know, I think in our case, in the Nordic markets at least, this is really like, it's kind of like a very, it's almost like a competition or something. We need to, like, we know there's going to be, you know, only a few players left in a few years from now. So who are they? And, you know, it's the dance around the chairs. And I don't know if that's something you call in the US, but it's an interesting time. But everyone is kind of like getting more professional.
That's interesting. One of my clients is from Denmark, so I'm learning a lot about Denmark over the last 6 months or so. And I've learned Yundala and all the, anyway, lots of things.
Yeah, exactly. We don't think so much of ourselves.
Yeah, so it's interesting though, because I do think there's that, I love your phrase, man up, right? There's a kind of a movement that I'm part of here in the U.S. that belongs around Man Up, the Man Up tribe. But I do believe that as business owners, it is an appropriate time to man up and take responsibility for your business. One of my favorite phrases is, "Nobody is going to come save you."
No, exactly.
You have to say, so to bring your, to bring your supply chain closer to you, that not necessarily geographically, but closer and more intimate with your business, so that you and your supply chains collaborate, and it gives you an opportunity to, because we're bounded closer now by what we do, what other people do, and by mutual success, right? We have to succeed together, and that's a much more powerful time for us, I think, as entrepreneurs, as business owners.
True.
Yeah, I mean, I also think, again, we're also just going through another Schumpeter cycle, right? This happens every year or two in the VC world. Doesn't matter what the trend is. Too much money flows in, you get a good exit, there's a huge exit multiple. All the dumb money, the 80% of VCs who don't know what they're doing, follow the 4 to 5% who do know what they're doing into a market. You have way too much competition, too many people chasing too few dollars, which gets into Amara's law. And then suddenly when it breaks a year and a half, 2 years later, and that specific hype cycle is broken, whatever it is, the iPhone fund or the pandemic fund or the biotech fund or whatever KPMG fund is, or Kleiner Perkins fund is out there, you see a scramble and a race to quality. In the 2 to 3, typically sometimes 4, but usually 2 to 3 best companies continue to get growth equity and do well, and more customers go to them. 1 or 2, maybe 3 will kind of carve out niche existences in really interesting spaces that no one else can survive in. And then the rest just they go dead, they get acquired, they become acqui-hires, or you buy them for their assets. And that's your typical Schumpeter creative destruction cycle, intersecting Amara's law, which is, in the short run, people tend to overestimate technology and the chain it brings on society. In the long run, they greatly underestimate technology and what it brings. And I'm sure, Uri lives in that world, because you're constantly going from, one hype cycle to the next hype cycle to the next hype cycle. And you have to stay on top of it, because VCs always have to be pros or strong enough that whatever the next hot thing is, but they're coming from a place where virtually no one in that industry even knows what it is. And so they're trying to get their 2,000 to 3,000 hours of expertise in, understand it, make a few investments, then jump on to the next one and the next one and the next one. And that's kind of where we are now. Is COVID has really compressed the current cycle across multiple verticals at once. And if we didn't have low interest rates, you would see a huge cleaning out of the of the follow-on VC community investments. And you're seeing less of that, right? Companies are still getting funded, particularly later stage funded. EBITDA is not important. Profitability still is not important, right? As important as if you run a company and you want to be profitable, the reality is VCs want every dollar to go back into growth. It's still a growth at all costs mentality, regardless of what they say, because they want, Facebook didn't make a dime until its 5th or 6th round. Google didn't make a dime until its 5th or 6th round, not even $1 revenue, right? These companies did not have business models, but they had KPIs that were exploding, searches that were happening, return searches that were happening, active members, which changed definition as it became a public company quickly to 1 year to 1 month. But, they had a KPI behind them that was exploding, and you're investing in them, hoping that this management team and these KPIs and this growth engine will be able to actually figure out how to make money from it. In both those cases, it was ad tech. But to get to your point, and some of the folks on here, beyond the front end B2C opportunities, we're seeing the Zooms of the world, anything that helps enable remote working, remote management. Pretty much everyone gets that. Anyone who has no operational or business background understands that that's an interesting opportunity. I wish I had, invested in Zoom 4 months ago, is kind of what everyone says. But we're seeing some really interesting things happen in the B2B community, because that's where people don't have operational expertise. That's where they don't have manufacturing expertise. That's where they don't have supply chain expertise, cold chain expertise, even getting into transactions into fintech. When you get into fintech, you have so many different intermediate players that have been built up over the last 60, 70, 80 years in the banking system that Square and Stripe and others have tried to compress and disintermediate. How does that accelerate, and how do you deal with those players who are still fighting for their lives and trying to transform themselves and maintain their relevancy? So I think B2B right now, and industrial and operations and really supply chain has gotten quite interesting. And those aren't overnight plays. You're not going to make money quickly in those. You're going to have to invest for 5 to 7 to 8 years. And typically the money is going to come from really early stage angels who understand the space. And then the growth equity folks who are placing bigger bets on those who have kind of broke through what they call the, for lack of a better term, the A-hole, right? Where it's really hard to get an A round, because that's where the biggest risk is.
And Seth, just sort of commenting on that, I think you can break the world in terms of entrepreneurs and investors into, are you a momentum investor or more fundamental? And to your point, we try to be more fundamental and sort of the Warren Buffett approach around sort of what's the actual value of this business? What's the book value of the business? And sort of not looking at others for valuation as well. So I think it's really good advice for entrepreneurs saying, regardless of what's sort of trending this month or this quarter or whatever, how can you actually focus on building fundamental value in terms of a solid business? And I think having been an entrepreneur multiple times as well, at times I found it really overwhelming because there's so much to do. There's so many things to focus on. Any given day, I would end my days, I still do in my job, sort of saying there's these 40 things I wanted to do and there's sort of so many things left. So I think it's also really wise from both an impact perspective for your business and also sort of a overall mental health perspective, taking a little bit of time and asking sort of what is truly essential in what you're doing. What are the few things, ideally one thing, maybe 2 or 3 that are really the 80-20 in what you're doing. There's sort of a whole bunch of stuff you can get wrong or sort of suboptimal, but what's that one thing that can really transform your business? So I like to read a bunch of books, and there is a book called The One Thing, which sort of, it says, ask the question around sort of what's the one thing that by doing this, everything else becomes easier or obsolete. And so I think asking those questions and pairing it with, forget the hype cycle and sort of go the other way where Harvard MBAs are running, go the other way where most VCs are focusing. What do you see in the world? And how do you actually start building fundamental value and ideally, controversially, a profitable business early on? Because I think there is something to be said about sort of saying, hey, we're going to build the next Amazon or Facebook or Google. Those are really generational companies, and it's awesome if you're going after that. Just know that the vast majority of folks doing that aren't going to succeed. So, if you want risk adjusted to build an awesome business that actually could be very large, it's sort of, you have to see that fundamental vision yourself and focus on the few things that are really going to help to grow that business, build awareness, and get your fundamentals in place. So you don't have to rely on any kind of investors, and ideally go to investors when you're at the place and you could say, hey, we have something going. Obviously it's not perfect, but we want to put fuel on the fire. We want to grow this. We want to test new channels. We want to expand our product. We want to gain market share, but we've got a good thing going already. So I think the few things that can get you to, we've got a good thing going. We want to grow this is kind of where you want to be ideally as an entrepreneur.
And in terms of fintech, what is in focus of your attention now? Maybe some of new emerging opportunities which are not that obvious. Maybe some of the contrarian strategies you're observing.
Sure, yeah. So, and to be candid, I'm pretty new to VC. A couple months in, I started my job during a pandemic as well, so that's been a whole different personal experience as well. Fintech is huge, right? It goes from all sorts of types of insurance to wealth tech to the back office. I tend to Seth's point, I tend to be really excited about sort of, if everyone's going off to California for the gold rush, the people that you'd want to invest in are the people selling shovels and tools to the miners, right? Because yeah, maybe 1 or 2 miners are going to strike gold, but the vast majority are going to sort of come back and sort of go back to their day jobs. So I'm really passionate about non-sexy businesses, anti-hype, back office stuff that can actually really fuel sort of a lot of businesses. So one of our most successful investments, we were kind of the first check into DocuSign years ago, and now it's a $35 billion company. Something like that is just drop dead obvious. People, all sorts of different companies have contracts. They want to sign it digitally. And when you sign it with DocuSign, you have natural virality, right? You have your co-signer learning about the platform and signing up. So it's just a drop dead, simple to explain, obvious use case, not very sexy, but really useful for customers. So taking that analogy to fintech, I think you've seen sort of version 1 of wealth tech where it's sort of the first robo-advisors, and you have Apex and a whole bunch of other platforms where people are building on top of that. So it's very easy to launch kind of niche focused robo advisors, but hard to make those businesses work. Now you're seeing that with sort of core banking and all these neobanks launching, and you're having that even globally with Nubank and others. So I think the future in many ways will be sort of balance sheet as a service, with Galileo and SoFi coming together for an offering, Amazon and Goldman doing things, and a whole bunch of others. So I think it's really around sort of if you're seeing an interesting platform play, how do you actually help small businesses sort of get access to capital better? How do you help companies get access to accounting data, payroll data? How do you help customers grow their revenue? How do you help people close sales faster? I think there's a whole lot of stuff around building platforms to help other people build on top of what you're building is very exciting and a good place to be. But at a very, very high level, I think it's sort of asking the questions. One, is what you're doing really, really solving a big problem or a need? Is it simple to explain? Do a lot of people have this problem? And third is, can you cost effectively grow awareness versus just buying ads online? And sometimes that works as well. But so I think it's interesting to kind of see as the world changes. And the last thing I would say on that is sort of lots of things were starting to trend, and it's actually a wonderful time to be in a lot of places of fintech, because now you've got to do all your sales online. So kind of SME banking, insurance companies looking to sort of do straight through processing online, auto insurance with telematics. There's a whole bunch of things that are just getting accelerated really, really quickly. So I think it's a great time for us to basically, as consumers, be able to transact from our living rooms, and for large and small companies to be able to kind of serve customers more seamlessly than they ever have before. But yeah, just keep it simple and get your fundamentals right. Easier said than done.
Not to put you in the hot spot, but just a question here, because obviously VCs come with their 100 questions, and startups like ours, we come with our 20 questions after we've both done our research on each other. And you come to that first meeting or that first Zoom conference, from what you've seen as a newly minted VC who was on our side of the boat once, and my side vice versa, are you still seeing the typical check the box? If you're not doing $1 million ARR, I don't want to talk to you. That kind of bifurcation of this is serious. And growth equity we get, that's further down the line, and that's just a numbers game, right? At that point, you're just adding fuel to the fire. You've already figured things out. In early stage, you're betting on the team and the vision, because you don't have the KPIs and the metrics necessarily nailed down yet. And then there's that whole, they call it the A-hole. Series A is always the hardest. And I found before the pandemic, if you didn't have $1 million ARR, 9 out of 10 VCs wouldn't even take your call, right? No matter how well you knew them, it's just, hey, that's what these guys do over here, and they're in the top quartile of net IR returns for all VCs. So I follow what they do. And after the pandemic, I'm still seeing that. How about you guys at Jackson? Is that kind of a top of the list if you're not hitting 1 ARR, 1 million ARR, trailing 12 mil and a half, or be on strong track, as the case may be? Because if that's the case, you end up missing, in my humble opinion, and not to speak about us in general, from all the companies I look at and invest in, you miss 80% of the opportunities that are out there. They kind of self-select themselves out. And so they're then at the mercy of, I need to go to early stage funds, which often aren't even funds, or I need to go to angels, which then becomes a networking play, which then falls into the whole diversity thing Nadya talked about earlier, which is you get the same people investing in the same type of companies and the same entrepreneurs because they know each other over time. Kind of how do you see the VC model changing, if I could hijack it for a second, Nadya, versus just the entrepreneurial model? Because the VC model has been rife for change for decades. You've got more money than ever, more competition than ever, and more over 198 new early stage funds with newer ideas, newer bodies, more diversity. It's small diversity, but more diversity than ever before. How do you see that changing, and what needs to happen to fund more of these better ideas versus just kind of the typical 2 and 20 and sit there on your GP checks and kind of keep the proletariat masses out from behind your kingdom walls, and just let the select few with $1 million ARR in, right?
Yeah, well, and interesting. I would say, well, Jackson Square, we try to be fundamental investors in the sense of we want to take very concentrated positions, and each of us will sort of make 1 or 2 investments per year. We're a small team, we're 5 investors. So we want to be that kind of Warren Buffett approach where we're high conviction. We generally want to take a board seat, put a lot of money into it, and really help companies through the good and the bad. And so I would say our sweet spot is 500K to $1 million ARR, but there's exceptions. We've invested in companies much later and some that are sort of totally pre-revenue. That's just our sweet spot. And we sort of want to be a little bit more like a horse with blinders, saying, here's what we're going out and doing, and we're going to wait and be patient and find those opportunities, even if everyone is sort of shifting to later stage or shifting to earlier stage. However, I would say to entrepreneurs a couple things. First is not every, and the vast majority of great businesses aren't VC-backed businesses, and that's not a bad thing. Like, you could build an awesome tens of millions, even hundreds of millions of dollar business without dilution, live your dream, have a global business, and fantastic. You don't need VC. There's a lot of great business models that are bigger or smaller than that just don't line up with pure software SaaS, which is fantastic. Just kind of know that if it's not a fit for VC, it's not a good or bad thing. It's just sort of a one type of financing. And I would say also for entrepreneurs going out and raising VC, stay true to your vision, and you sort of want to do that investor dating. Don't bend over backwards trying to make it work with an investor. Go out and talk to folks and figure out people that really buy into your vision that can help give you the support. And to your point, Seth, there's sort of that cycle happening in the Schumpeter cycle, and that will also apply to funds. A lot of funds just sort of raise, and there's a lot of money still out there because they're sitting, we're sitting on a 7 to 10 year time horizon per fund. And so we'll have a lot of funds closing down, going out of business as well, and sort of a lot of VCs acting like sheep and following trends. We're trying to sort of behave differently than that. But I would say, for us, we have that sort of 500K to $1 million ARR target, but every VC is different, right? There's we will miss a lot of opportunities with a lot of sort of great seed stage companies, which are sort of, are you an awesome team, and do you see something, and do you want to sort of see where this goes? And there are sort of stages later than us, which is sort of, okay, you've got to 10 or $15 million of revenue. Can this thing cost effectively scale? Can it get big enough? Is this the right team to lead it? How quickly can we go to an IPO? And so there's different stages for that. So I think, well, also it's just, as a VC, it's sort of the most important thing is sort of the opportunities that you miss, right? So kind of sort of making sure you catch the right ones, but you're gonna definitely miss them if you have those that sort of boundary, and then you sort of don't go outside of it. But then again, you also have to hold yourself true to your own values and your own fundamentals as well, which is sort of, what's your sweet spot? What are you good at? And saying no to things that are sort of close, but not quite there as well. It's tough.
Thank you, Uri. And Christian, so you were lucky to fundraise late 2019. So what are your next round, if you plan one, and how is it in terms of sufficient funds, and do you feel sustainable enough?
Yes, we were very lucky to raise around $3 million altogether dollars during the COVID. But that was also based on some dialogues we had before, but it was really like a good time to just reinvent the story about our company. And in our case, we have a pretty good vision and a strong value proposition and almost no churn, because it just makes sense what we do. So that was really lucky, and that's also what the investors basically came and said, you obviously have a lot of the different dialogues, but if you have something, then the investors, they want to close in on something that they also believe will be there in 3 or 4 years, right? So in that case, Shopbox was in a fortunate position. And the next round we're going to do is an A round later this year. Actually, we started out 2 years ago launching the product, and it's been really growing fast organically and with almost no force, and we bootstrapped a lot. But recently it's been going very fast, so we're going to raise an A round towards the end of the year. We're trending now at $1 million ARR right now, and it's growing fast. So that's the next plan. And then we have some strategic investors as well lined up, but we probably would do a financial a capital round, and probably also outside of the Nordics, because we would like to look into new bigger markets. We do a very good, a very strong product in the Nordics, could work in any market with any bank. So that's what we're looking to do. It's exciting times.
Yeah, thank you so much, Christian. And James, do you plan any fundraising for your own company as well, or what is your strategy?
No, right now we're still just completely self-funded and we're planning on keeping it that way. There's no real need to go after hyper growth like Uri was talking about. Some people have business models that fit the VC investment mandate and others don't. And for us, like we tend to focus on working and partnering with startups, and we've been able to continue growing during this time. And we don't need necessarily a larger cash infusion to really, I'd say, accelerate that growth. I think maybe once things begin turning around and once people start looking more towards hiring again and building out their teams, which is our core business, it might make sense for us to go pursue a fundraise. But at the moment, we're just focused on keeping the ship steady and growing at a steady rate.
Dolan, do you have any comments to add?
Well, it's interesting because I tend to, being a solopreneur and then doing the other kind of ventures that I'm doing now, there's two others that I'm focused in, which is one, it is enabling organizations to move into to implement digital strategies so they can actually go sell in a digital model. It's kind of those I believe very, very strongly that's an important strategy for lots of businesses who don't have that capability. And the other is I spend a lot of time teaching and living in the world of mindset. But it's interesting listening to the conversation about venture capital and about the 1 million ARR and kind of where you see it. One of the questions, and I'll kind of pose this back, is from your stance, maybe Uri and Seth, is kind of the question about the cost of missing those opportunities. Because I believe we're also in this place from an experience where the new what will be the generational, I think Seth, you call it the generational things, Google and these kinds of businesses, Facebook and those kinds of things are yet to be found, and we're going to see things be invented because of needs and customer requirements. So kind of how do you balance that weight of missing those kinds of opportunities? So I'm kind of curious about that. I'll put it back. I'll start with Seth. How's that? You're not on mute.
90% of small businesses are going to fail. 90% of startups are going to fail. 4 to 5% of the VCs generate 90% of all the net IRR. Most VC, right, LPs lose money in their investment, right? If you put money in the S&P 500 over 10 years, you would have made more money in an S&P index fund than you would have made in a VC fund. So everyone's really chasing after those, kind of 85 to 90 GPs who are more mobile now. They can actually switch between funds. They aren't stuck with the same fund for life like when I was younger, because they have proven that they can produce outsized investments more frequently than not. They still have plenty of dogs and plenty of losers, and they're going to write 7 out of 10 or 6 out of 10 of their investments completely off. But it's those 1 or 2, right? So even if you look at Andreessen Horowitz, where Mark built a company, he built a browser, he changed the world. His first fund, it was 2 out of 10 funds, last data I saw, that are top quartile funds. His other funds aren't. And given the first 5 years, you can't really judge a fund because you haven't made enough investments, but kind of year 6 through 10, you can start to. And that first fund was Skype, so it wasn't even a new idea. They had just bought back an idea that had been there before. Right. So if you look at most companies, if you look at Facebook, there was a half a dozen social media companies before them, but Facebook was the right group at the right time with the right capital and all of the right ingredients. Google, we all remember there was a dozen other search engines, right? And if you ask any VC what was the most successful, clean A round of all time, 9 out of 10 VCs will look at WhatsApp, they'll look at Instagram, they'll look at Nest, they'll look at all the usual B2C plays. And then when you turn around and say, there's emergence capital investment in Viva, right? Viva was built on top of Salesforce. It's a healthcare vertical play, right? And it outperformed every other B2C deal by at least 1.5 orders of magnitude. 9 out of 10 folks don't do that. They just haven't done the research. So you really have to look at, as you say, you have to look at the winners. The net ARR, it's kind of like being a publisher. It's easy to say, hey, you don't have any revenue, we're not going to look at you. But the biggest players out there, the biggest returns in all times, didn't have any revenue. And to James's point, you don't necessarily need to take that VC money now, or that angel money now, or that growth equity now, if you have a business model and you can either self-sustain through that revenue, or you can self-fund, as the case may be. Because I've seen plenty of folks who have had 5 home runs and their 6th one was an absolute disaster. And I'll just mention the name Colors, and there's another dozen out there. But yeah, I look at it from my point of view as, when you've done enough of these, which I think a lot of us have, and I know Christian has too, you realize that people, which include your investors, are your strongest asset, right? The team you have, the team you build around you, and your advisors, your board eventually, and particularly your early investors. And so for us, it's always been about finding the right early stage investors that are smart money, know some aspect of your business, have networks, and are more than just a check. Right? Because any given VC, if they really like you, they'll make a couple calls a year on your behalf, but they've got a half a dozen other or a dozen other portfolio companies to deal with. And if you're not their top 1 or 2, they don't have a lot of time for you. And it's not because they're bad people, it's just because they're busy like all of us are. But an angel who knows the business and is networked will spend a lot of time. And some of our angels are on weekly product calls with us. They are, the smartest applied AI minds in the world who have been doing applied AI in 3-letter agencies since the early 80s, believe it or not, because that was the only compute and memory concentration you had that could actually do basic AI.
Can I add something?
Go ahead.
Sorry, I just wanted to add something you said before about the people, right? Because basically, also as Uri said a little bit, it's not about the investor. Sorry. It's not about the investor, but it's about the people and the investors believing in those people's ideas. Yeah. And I think many startups get it wrong. Like, they want to look nice for the investor. They're like, oh, I can get this money or something. And that's the last thing the investor wants, because the investor actually doesn't know where anything is going, because obviously you cannot track, any kind of vertical in any kind of business. So, you want to invest in people who know where they're going and who's going to do it no matter what. And maybe they have some, learnings from other startups or something. Those are the truly, that's the only thing you can really, count on is some people who've done it before, who has some traction. And in the same cases, like investing in more expensive personnel, it's also maybe a good thing to maybe pay a little bit of an overprice sometimes for an investor to, assess this thing. It's such an important thing. And, I've seen a lot of VCs with, long educations who doesn't know how to do this, because they don't know how to deal with people. They don't know how to ask the right questions. And then later on, they find out that, this is the plan, but they never really had any kind of agreement or, chemistry even. It's like, it's these things. So it's just a comment, because it believes it's so important. And like my last thing in this, actually, with the round we just did, I thought a lot about how can I contribute the most to my company? And what I actually ended up doing was to say, I'm going to be the HR, internal HR of the company, because the most important thing I can do is to make sure that I don't send any idiots inside the company. And then hopefully I have someone to manage it. But that's actually the single most important thing you can do, I think, as an entrepreneur when you grow your business. And it's something that entrepreneurs don't believe, because then they think they should be the CEO or the next thing. The people you put into your, living room, those people are going to mess up your company or make it amazing. And that's the only really important thing. So that was that.
Also, I think the very important to identify the trend in the beginning of this trend, and then to find the appropriate company and idea to invest and accelerate this trend. Because without trend, it's just waste of money and time. Or if you are in the middle of trend, it's too late. So I think the most basic idea behind right investment, it should be based on trend, initiation of trends, and the best way to envision this trend and actively accelerate it, not passively follow.
Thank you so much to all. So this brings us to the end of our today's discussion. So we welcome you to join our Startup Leaders Club. We have it every week on Tuesdays, Thursdays, and Fridays. We also have keynotes, masterclasses, roadshows, and pitch competitions. So you're welcome to join different types of communications between venture investors and serial entrepreneurs, and advice on your own formats of interaction if you would like to introduce some of the new formats. Thank you all, and we wish you all the best for the rest of the week, and see you soon.